Now, when you say the full process, meaning that the other people will kind of wait by the side. Now, is that because you had a good relationship with the broker that you were able to say that, and the broker's basically kind of marketing you to the seller, or is that something?
Yep, that's definitely a big part of it. So that's where relationships really come in handy. You need the broker willing to go to bat for you, and that'll start to happen as you close deals. Before you close deals, what'll happen is it'll start to happen from effort. They're not going to do it if you're on the first deal. They're not going to do it if you're on the second deal. But if they see that you put in 10 or 15 offers and you haven't got anything, and you've been working at it for 6 or 12 months, they may say, let's give this guy a shot. We'll vouch for him, give him a shot. He's consistent. He shows up a lot. He goes on tours. He puts in offers. So they know that you're a serious, legitimate buyer, and that they're willing to take a chance on you because you demonstrated that you're worth taking a chance on.
Gotcha. Okay. So now this one here, did you do this preemptive offer on this one?
This one we did not. So we went through the full marketing process. I got to start very late. And what happened is about 3 days before the calls for offer, because I was busy at the time that it came out and I didn't get a chance to look at it. The broker called me and said, listen, we have low interest in this one. I think you should take a look at it. So I said, okay, let's take a look at it. So it was part of a portfolio with 4 of the properties, and all 5 of the properties wound up going to different buyers. They sold off separately. And what I did was I took a look, and even by the point the call for offers came, I wasn't really confident that I wanted it yet. But I said, okay, let me put an offer in just to be competitive, but I didn't put our highest offer in. But it was good enough to make it the best and final just because we had a better track record than some of the other groups. So then at that point, I started really digging into it and said, okay, you know what? Let me make sure that everything's good because I don't want to wind up getting something that I regret. So I started making a lot of phone calls, called property managers, called tax assessors, called insurance agents, just to make sure that everything's penciling out and that we have a good concept of the property in the area and what we can do with it. So then after that point, when we went to best and final, even though we weren't the highest offer, we were able to get the deal because the broker vouched for us and the seller said, okay, let's go with these guys.
Wow,
so
that's interesting.
the broker relationship helped a lot.
Why do you think that there was low interest in this market? Because that kind of like, okay, wait a minute. Everyone I've always gone, my gosh, what was it? Was it because it was in a portfolio and people don't want to get involved in the 5 different properties?
So I think that may have been part of it because altogether would have probably been about 990 units on the whole portfolio. But I think the other part is the type of construction. It's what's called Cardinal property. So for anybody who doesn't know what that is, they were properties built by a company called Cardinal in the 70s, 80s, and 90s. And they're exact cookie cutter layouts, whether it's in Georgia or Florida or North Carolina or Ohio, you're getting the same property. The floor plans are exactly the same. The unit mixes are very similar. And they're really a workforce housing demographics. So it's not a bad demographic, but you're going to get, people that are your blue collar workers. You're going to get your bus boys. You're going to get your stock boys, people that are usually making lower end wages on the earning scale. But obviously they need housing too. So between the demographics and the construction, oftentimes those properties give less competition. Now we had another advantage because we actually own the Cardinal property already. So one thing that makes sellers a little bit reluctant when they pick a buyer with these is they may be picking a buyer that's underwriting it incorrectly. And the reason for that is that they're assuming that they're going to get 80% financing with agency debt. They're going to be mistaken. And we already knew that because we already owned one. So we knew, okay, we have to use 70% on our financing. That's all you're going to get. Agency really isn't going to be a viable option. So we knew that as well. And we had a plan in place to go with CMBS financing. So because of all those factors, you see lower competition. If you see a deal with 80% financing, that's something you'll get a lot more offers. But in this here, between the lower leverage, the demographic, and the construction type, oftentimes you'll see less interest in Cardinal deals.
Okay, yeah, because that struck a chord because you mentioned on another podcast that I had looking at a Cardinal deal as well a couple months ago back, and I learned all about that type of housing, and I couldn't go to agency, and that kind of really affected our okay, how are we going to do this, right? But it was a great looking property. Yeah. Also, but it does take a little bit of work. There's nothing wrong with the construction of it. It's just the agency debt And agency debt for people on, well, that's your best pricing, right? That's
Mhm.
your lowest interest rates, longest terms. That's what everybody vies for. So
Right.
with this Cardinal, it's kind of, you got to go, what'd you say, CMBS, you went there, which is a little higher interest rate, right?
So, the rates are a little higher, but not too bad. But you really have two viable options. You have CMBS or you have Bridge. And to me, I think there is a place for Bridge, but I do feel that there's a lot of misuse of Bridge in general at this point. And I think where we are in the cycle, it could be very dangerous if we have a downturn for a lot of people.
Gotcha. And plus you had already owned Cardinal, so you already had your lender already prepped for that. There's nothing really wrong with it. It takes a different type of lender to lend on that property.
Mm-hmm.
Okay. Awesome. So you obviously got that. That one is closing here soon. What are some of the road, I should say, the speed bumps that you ran into when you were doing the due diligence with this one?
So this one's actually went pretty smooth. A lot of times it's your expectations going in. With the Cardinal property, especially being that we owned them, we knew what to expect. So there really weren't a ton of surprises. We know that you're not getting an A+ property, but you're also not getting a D asset. So you're getting, lower level housing that's going to be solid. And the goal is to make it clean, comfortable, safe. So as we did our inspections, structurally the property was in good shape. We had somebody check out the crawl spaces; those were in good shape. The roofs. There's 20 buildings on this particular property. 16 of them need to be replaced. While that may sound like a lot, we were budgeting for all 20, so 16 was a win. So we were actually pretty happy about that. So we said, okay, we can salvage 4 of them. So that worked out good. Overall, the exterior of the property is in decent condition. We're going to do some sprucing up with the landscaping and the parking lot, but overall it's in decent shape. So we were happy with that. And with the demographic that he attracts, I think with the condition it's in now, we'll have no problem continuing to get that demographic.
Interesting. So now with the CMBS type loan, what kind of term is that? I know agency debt is a little longer. Now, I'm asking 2 questions at once. Let me start back. 1, what is your hold period on this property?
Yeah.
And 2, then what type of debt the CMBS was?
Sure. So the hold period is 3 to 7 years. So whenever we do our projections, we're usually targeting 5 years. But when we do our offerings, we typically put 3 to 7 years because we always want a range. And sometimes it may be even shorter than that. And in real rare occasions, it may be even longer. But the thing is, let's say the market continues at the blistering hot pace that it's at now. We're going in paying $60,000 a door for this property. Let's say somebody comes up next year and says, okay, we want to give you $85,000 a door. Is it to say that we wouldn't sell it just because it's year 2? Absolutely not. We'd be foolish. So we would sell it. We would give people their money back and say, listen, thank you for investing with us. Come back and invest again the next deal.
Exactly. Yeah, that makes sense. And that's a pretty good. Now, knowing the area, that's obviously a pretty good price. I don't know that area, but that seems like to me that's a pretty good price for that area.
Yeah.
You already in that area knowing that. Okay.
And then on the financing, we're at a 10-year term with the CMBS lenders. So we're at a projected rate of 3.95, but that could still change until we actually lock it at the end. And then also we have 3 years of interest only. The big downside to CMBS debt is that when you do go to sell the property, oftentimes you may have a steep prepayment penalty.
Gotcha. Okay.
So you can do that with the agencies also, but with CMBS, it's oftentimes very prohibitive.
Gotcha. Now, but doesn't that burn off after 3 years or something like that, or is it the total term of the loan?
So usually, I think 3 years is probably the minimum that I think they want to see, at least 3 years of interest payments, but that'll really vary from lender to lender. And then even after that, it will be steep. So they don't have a step down like the agencies do. So it will be a pretty high number all the way. But one of the options we can do is sell it with assumable debt. That's actually what we're doing with the other Cardinal property we have in the Atlanta market. So we're selling that one now, and we're doing that as an assumption only because that's also CMBS debt.
Gotcha. Okay. So it has that high prepayment penalty, and they can just assume the loan. That's awesome. Okay.
Yeah.
So now let's talk about the next one you're closing, because you got 2 closing, which is awesome. Give me some ideas on that. How many?
Yeah. So this one here is kind of an interesting story to it. It was 64 units in Columbia, South Carolina. And with this one, what happened is we actually had it under contract at the end of 2020. We had 2 deals under contract simultaneously. One we closed, and unfortunately, this one we didn't. What we realized is that we did not have the investor base at that time to do 2 deals at once. And quite frankly, we made a mistake. And in particular, at that time, the property wasn't stabilized. So our investor base didn't want that. Our investor base wanted stabilized assets that would cash flow right away. This one here had an interesting story to it because when the seller bought it, it was a total mess. He bought it in November of 2019. He put some money into the property and he got the physical occupancy up. It was about 50% when he bought it, and it was around 82% at the time we got it under contract. Okay. But unfortunately, with 82%, you're not qualifying for agency debt. And one of the things I learned is we were looking at bridge options, but I didn't realize how expensive bridge got when you were below $5 million. And what happens is when you go larger with bridge, the terms are very competitive. When you go lower, they're almost like hard money. So you're looking at, rates in the 7s, 8s, and 9s. And we said, it just doesn't make sense. We can't make the deal work like this. So fast forward a few months, we had actually put the broker in touch with another group that wound up getting it under contract. And, I did that because I wanted to make sure to salvage that relationship because that was our best broker relationship. Okay. And they were a group that's out of state. And they brought us in, 1, because, they knew we had found it, and 2, because we could be boots on the ground. So in that regard, it worked out well. And now they got it on the contract at the beginning of May, and we're pushing for a mid-July closing on that one. So we're doing good on the equity, good on the debt. And I think another 2 weeks or so, we should have it closed. That's so awesome. It took some work on that because we had it, we lost it, and then wound up back in it. So it was interesting, but it gave us some lessons learned.
Now, is it the same broker that you dealt with when you initially lost it?
Yeah, same broker.
Okay.
So he's also one of the guys that pushed for us on the Greensboro deal. So I had to make sure to keep that relationship strong because he's probably our best contact.
Okay. So so you didn't sour the relationship. You saved the relationship for him to come in and help that. Okay. One thing you mentioned is your investor base, and I had some questions about that. Your investor base initially, you said, wasn't that strong. You take on a property, and this occupancy was what we would maybe say a little bit of a heavy lift. So your investors at that time weren't used to that. Have you gotten them used to that with your subsequent successes you've had, or
not yet?
Not yet? Okay.
No. Most of the people that we like prefer stabilized assets that are cash flowing right away. The people that invest with us. And, we eventually, as you grow your investor base, you'll find people who like different things. So different people have different risk tolerances. And some of them are going to say, I only want to invest in a stabilized asset, but others are willing to take a chance on something like that with the prospect of a greater return. Now, one of the things that happened with this property also in between, from the time we terminated the contract until the other group that we're partnered with got it under contract, the property became stabilized. So now it's a stabilized asset and it qualified for agency debt. So financing terms were a lot better and it's cash flowing right from the get-go. So the situation's changed a little bit and it was a lot easier to get equity for this time.
Okay, that's cool. So I guess the other group had it, so you're kind of partnering with them. So some of your investors feel comfortable now because the occupancy's up and at cash flowing. Okay, awesome. Well, that's cool. Now, on your underwriting, you're in charge of doing the underwriting, obviously. What type of rules of thumb are you looking for when you're looking for these deals? Now, is that based on your investor base? What they think they can handle? I know it's kind of a general question.
So most times we shoot for a minimum cash on cash return of 7%, minimum average annual return of 15. And those were our main criteria. Now the goal obviously is to be higher than that. But what I usually tell people, and I tell our investors this also, most of the deals that we put out will usually show lower returns than a lot of other groups. And if you're looking at it from a really high level, seeing 21% versus 16%, it's you're thinking automatically, okay, let me go with 21%. And part of my reason for that is I'm oftentimes conservative on my underwriting, sometimes too conservative. And that can be a blessing and the curse, but I've always said that I'd rather have conservative underwriting keep me out of a deal than aggressive underwriting get me into one. So my thought is if I can show you 16% and then we can hit 20, that's great. But all of a sudden, if I show you 20 and we hit 16, now you're disappointed. So I'll show you 16% every time with the intent that we can hopefully hit 20.
Gotcha. Okay. And that's good. That's the, what is it? Under promise and over deliver kind of a thing, right?
Yeah.
That's interesting. You were quoted in another podcast saying implementing your value adds in year one, you can see a 10% cash on cash return. Kind of explain that a little bit more for me.
So I'm not sure which deal that was in regard to. It may have been our 48 unit deal in Sumter that we closed last year. So that value add was actually probably my favorite type of value add. It's an operational value add. So if given the choice between an operational value add or a physical one, I'll take operational every day of the week and twice on Sunday. And for those that don't know, so an operational value add is when you're not going in there and doing some type of cosmetic upgrade, but you're making a management play and you're doing something differently. So what we realized with this particular property is that it was a 48 unit property in a tertiary market in South Carolina. And when we first looked at it, we saw the rents were between $575 and $650. After really looking at the property, surveying the comps, becoming familiar with the area, we felt very confident that we could hit $750 on those rents because we saw similar vintage assets, similar sized units, similar areas going for those rates. Our property manager even said $850. I have to admit, I didn't believe her, but I'm glad that they proved me wrong. So in a matter of 9 months that we've owned that property, the rent roll is just above $28,000 a month when we bought it. And now as of, last week, it's at $35,000. So we've increased the rents by $7,000 a month in total. And we're still increasing more because as leases renew, we're pushing up further. And all we did on that was simply send out renewal notices because the advantage that we had on that property was that of the 48 units, 27 of them were month-to-month leases. Now, some of you may think of that and say, wow, that's a bigger risk. And there's truth to that. It can be both a risk and an opportunity depending on how you manage it. So our management company was on top of it. They sent out renewal notices at our request, pretty quickly after buying the property. And the renewal notices, most of them came with $75 to $100 increases. So you can imagine a lot of people that were paying, nice affordable rents aren't thrilled. But what they realized after they calmed down, they went online, they went to Zillow, they went to apartments.com and all these other sites. And they looked around, they probably saw that anything of similar quality in that area was going to be even higher price. Mm-hmm. So they probably realized they had a good deal at that point. And that if they wanted to pay in the same rent range they were, that they were going to wind up in a lower quality property. So because of that, we've been able to really push rents and now we're actually at 900. So we're higher than we anticipated by quite a bit. So that was probably the deal I was referring to in that. So
that's interesting. Okay. So now when you underwrote that deal or any deal, year one, year two, what are you looking for? What are you putting in there for escalation of rents? Because I've heard people say 0. I've heard people say 2. Obviously, you're obviously getting a lot more than you probably projected.
Yeah.
What are you doing?
There's 2 components that you're going to have to rent growth. So one is going to be your organic rent bump, which is just like a cost of living increase. And the second will be from any value add that you're doing. So for the organic rent bump, in most markets right now, I'm using 0% in year 1, 2% in year 2, 3% year 3 on. And truthfully, my reason for doing that is that from watching a lot of other groups, I see them doing that. So it was just something I said, okay, this seems to be what people are doing. So let me start using this method as well. Now, if I want to be more conservative, I'll just do 2% straight across the board. And while it may not sound more conservative because you're actually showing some growth in year 1, 2% over 5 years is less when you start compounding with 0, 2, 3, 3, 3. So it actually comes out to a slightly lower return. Now, for the rent bump that's coming from the value add, that's really going to vary from deal to deal. And what I would tell you is that you have to know your market. And ultimately, what you want to do is you want to rely on your property manager's expertise. They're going to be the one that's the expert in that area. They're renting units all day long. So they can give you that data because they have a wide sample set to go to. And there's a good chance they're managing similar assets in that area. So you want to rely on their expertise and what they can do. So normally what I would recommend to people is that if you're doing a physical value add, you have to be realistic. So if you have a 300 unit property, it's not realistic to phase that value add in year one, unless you're going to vacate the property, which for anybody starting out, I would certainly not recommend that. But the thing is, even for me, I wouldn't do that because I always tell people rent growth is important, but occupancy is more important. I'd rather make sure there's money you pay the mortgage and money you pay, what we can to investors. So we have that. So I don't want to dip the occupancy too much. So you want to be realistic with how you're doing your upgrades. So if you have a 300 unit property, most times you'll probably do, if everything goes perfect, and most things don't go perfect in the real world, but if things go perfect, you go 8 to 10 units a month because you need your lease expirations to line up, and just other factors as well. Realistically, you're probably doing 6 to 7 units a month. So you want to figure that and divide those increases accordingly. So for a 300 unit deal, I would tell you you're probably doing a third, for simple math, a third in year one, a third in year two, and a third in year three. Now, depending on how fast your crews move, it may be something more like 40% year one, 40% year two, 20% year three.
Gotcha.
But for simple, my thought is always keep it simple. And even if I go with the slower method, if we can exceed that, it's even better.
That's awesome. Well, listen, I'm going to stop asking questions. I'm going to turn it to the audience and see if they have any questions for you. I hope they do. If they don't, I have a bunch else here, but go ahead and chime in, unmute yourself and ask Charles. And thank you, Charles, for all this information. This is awesome. Go ahead and just speak up and ask your question.
Thanks, Pat. How you doing?
Good. Hey, what's going on, Daryl?
All right. How you doing, Charles?
Good, Daryl. How are you?
All right. Question, when you're looking at your underwriting, such as the other income, do you look at, or how do you figure if for RUBS, or say if you're going to incorporate parking or laundry or something like that, how do you incorporate a specific amount to per apartment for the other income? Is there any kind of method that you use?
So Daryl, it's a great question. You may not like the answer I'm going to give. So most times when I'm doing my underwriting and showing my increases, it's rare that I ever adjust the other income. And the reason I do that is because I look at that as a bonus more than something I'm counting on. So I'll adjust income for the rent. I'll adjust the vacancy if I see that they're off, but I don't typically adjust the other income. Now, if it's something substantial, like for instance, they're in a market where they could be billing back for water sewer and they're currently not doing anything at all, and I know we can do better than that, then what I'll typically do is I'll phase something in. So like with the water sewer bill back, it'll probably take you a good 2 to 3 years to really recognize everything being implemented. And again, you're waiting for leases to expire. You're waiting for things to kind of catch up and cycles to come due. So I'd probably put 40% of my general rule is I figure I'm going to recapture somewhere between 85 and 90% of the water sewer bill. And I would take that recapture and put probably 40% of that in year one, an additional 40% in year two, and the remaining 20% in year three. I would only do that if they're not getting anything currently. If they are getting some already, I probably wouldn't change the numbers too much. I'd leave it pretty close.
All right. Thank you very much.
You're welcome.
So I have a question.
Yes.
Have you used any private equity providers?
Not yet. We'd like to in the future, but not yet. No.
Not yet. Okay. Yeah, I want to speed up, so I'm looking for one. So,
what I could do is I could connect you with some equity broker dealers. I do have relationships with them if you're open to using them. And a lot of them do have private equity. So just shoot me a message. I'll put it in my information in the chat box, and then I can connect you with them afterward.
Definitely. That would be awesome. So as earlier Pat mentioned, right, my goal is to do 2,000 units this year and next year 1,000 plus.
I was impressed with that because I said, you know what? I have to up my goals. I only set a goal for 1,000 this year, so I need to do better.
Yeah.
I did the same thing. It's like, oh my God, I'm not shooting high enough. That's
right.
So I need to speed up. So one of my biggest challenges is reaching out to all these retail investors and get the money. So in a day, we only have 24 hours and I'm still doing my W-2 job. So
right. Yeah. And for a deal that size, it gets to a point when you start doing some deals that I don't want to say it's impossible to fund with individual investors, but it's certainly very tough. I'm sure a deal that size, there's got to be some type of big money backer, otherwise you spend all day long raising money from individuals.
Yeah, I want to have a backup plan. Like if I'm short by like $1 million or $2 million or something like that, I should be able to reach out to somebody quickly and then get that money. So that's what I'm looking for. So the time being crucial.
Sure.
Okay, I will ping you privately. Yeah.
Sure, sounds good.
Anybody else got a question?
Yeah, I have a question, Charles, regarding CMBS. And
yes,
first off, congratulations on the deals. And,
thank you.
And want to say that you were one of the biggest go-givers that I know, and that I'm proud to know you and all the value that you add for our organization. I really appreciate that.
Thank you, Jim. I appreciate being part of it. The GOB Network's a great resource.
And but regarding CMBS, I know that it's in my circle of friends, in my network, very few people use it. They've got a little bit of a bad reputation because of possibly what happened during the last downturn. CMBS loans were really a big major part of the economy kind of blowing up, and I think that. A lot of people have this belief that it's almost predatory lending, but and I'm saying all that to say those are the reasons I have shied away from it. But I have always had this lure because a lot of deals are getting done. So Charles, I really would like your input. Some of the questions that I have. Are you able to, because of the heavy prepayment penalty, are you still able to get really good terms if you go with a much shorter, let's say, for instance, a 3 to 5 year loan, as opposed to a longer term at 7, 10, or 12?
Yeah, so you definitely can get good terms. What I would say is you'll probably wind up with a slightly higher interest rate on the shorter term, but overall, a lot of the other terms will be pretty similar.
Well, I'm finding the same that you are, especially in tertiary markets, on smaller bridge loans, 5 million, anywhere from, really honestly, anywhere from 2 to 7 million. That until you get over 10, it's hard to find players that want to do those deals.
Right.
And I've really been looking for someone to fill that gap, and I have been curious if CMBS was a place to go for that. And it sounds like you've done a few deals.
I would say yes. I think that they're a better fit probably than bridge in a lot of cases. I think they also have stricter underwriting standards. The good part about bridge, and I think the reason so many people are using it is really two reasons. One is that a lot of times they'll lend more than agency or CMBS will. And the second point is that they're very flexible on the prepayment penalty. So oftentimes, you can negotiate it where you may not have any penalty on the backside at all, depending on your exit period. So with CMBS, it's a lot more prohibitive in that regard, but you'll get good terms. They will be stricter on the underwriting. And from that point, they'll usually wind up being a good fit. They're also a lot more regulated than they were in 2007 and before that. So a lot of the negative stigma that CMBS had back then is a bit different now, because even though they still repackage and repurpose loans, there's a lot more tightening of standards than there was then.
And cost on bridge loans has gotten very, very large, like 3 times the cost of agency to initiate a bridge loan. What's your feedback or experience on CMBS in that regard?
So with CMBS, we're using Ready Capital, and for them, the fee is $35,000 that we paid on this deal. So it was a little more than we pay in our agency deals, but not anything too restrictive. By the point we get to closing, I'm sure with their fees and everything, we might be a little bit above that. But, overall, they're pretty similar, I'd say.
And what about rehab in the CapEx?
So most of them will not finance it. Some will, but most times you're going to have to go bridge to get the CapEx financing.
And I've heard that they will be a lower LTV even than agency. Is that your experience, or?
You know what? I can't really say because we've only used them on Cardinal properties. So in that case, on the Cardinals, they come in at 70%, where with the agencies, one of the agencies won't even touch Cardinals. I think it's Fannie. And the other one will, I believe, Freddie, but they usually get like 60%. So in that case, they look pretty good, but I've never really looked at it on a regular deal, so I can't say.
And that maybe you can answer this because you own a couple of them. I've never owned one. What is it about the Cardinal building method that Fannie has blacklisted them?
So I think it's the wood frame construction. A lot of them have, so the two most common issues that you have in the Cardinals are polybutylene plumbing. So if you have one that's not been updated, the polybutylene plumbing is an issue. And a lot of them also have subflooring issues. So like the one that we have on the contract now, 112 of the 130 units, the seller had already upgraded the polybutylene plumbing. So that was a plus. And then with the subflooring, even though they upgraded 72 of the units, apparently they didn't spend any money at all at subflooring, because I know that everyone we walked, you could feel some type of subflooring issue.
Yeah.
So it's usually the combination of the construction and also the workforce demographic. With Fannie and Freddie, while they will lend on it, they're not keen on the Cardinals at all.
Yeah. And what do you usually budget for the polybutylene remediation per unit?
Most times you'll be at around $1,500 a unit, depending on the area, but give or take right in that range.
So great stuff, Charles. Thank you very much.
Thanks, Jim.
I have another question for you, Charles. What are you excited about right now, other than your closing two deals?
Well, I was excited about trying to reach my goal of 1,000, but I might have to get more excited and set bigger goals, after tonight's event.
Sorry, I didn't mean that.
But I was joking around because I said we're really behind pace, because once these deals close, we'll be at roughly like 258 for the year. So I said, we need another 742, and you may look at it and say, okay, we're halfway through the year as of today. So it sounds like a lofty goal, but I'll tell you this, I feel good about hitting that goal. So there's been a lot of work and a lot of effort that's put into this point. And what you'll notice is with every deal you close, your track record builds a little more. So as you start getting, access to different deals and different resources that you wouldn't have had before, it gets a lot easier to continue building momentum and make things happen.
Awesome. Also I'll dovetail on what Jim said as far as giving back. Now, every Saturday you conduct 3 hours worth of free underwriting training, which is very detailed. And how would people, if they haven't been on that, how would they get enlisted in that and get on your mailing list to be able to partake in that?
So the easiest way is to reach out to me. My contact info is in the chat box, and just tell me that you saw me on Pat's Meetup, and we'd be glad to add you to the list if you're not in there already.
I can tell you, I've joined almost all of them, and it's just intense, and it gives you a great feeling. That knowledge that he provides, it's just awesome. So thank you very much. Now, when did you start that? Did you start that because you just wanted to get better at it? Does that really help you get better, or is it just?
It's a good question, because people ask me that, and I don't know that I have the answer to it just yet. Initially, when I first started it, what happened is we had brought on, for lack of a better term, what I call unpaid interns at the end of 2019 and early 2020. And most of them were guys that we met at local meetup events that we saw that they wanted to start out in multifamily, but they didn't have any direction. So we worked out an agreement where we would give them free training on the acquisitions and the broker relations and the underwriting side of the business in exchange for them looking for deals in different areas that we weren't in. And that did a few things. One is that it increased the amount of deal flow we had at that time, because we didn't have as much deal flow coming in. And secondly, I jokingly told all of them, I said, listen, I don't mind creating competition, but I'd rather create indirect competition than direct. So I said, eventually when you become successful and you want to run your own deals, then you'll already be set up in that other market and it won't be, in the same market. We're okay. So I figured it was kind of win-win scenario. So we had quite a few guys that expressed interest in it. I usually capped it with 5 at any time because I didn't realize initially when I first started it how much time it would take up kind of going back and forth between everybody and training. And I said, wow, this is more time consuming than I thought. But I started doing those sessions in person and we would just have a small group, 4 or 5 people every week. And then the pandemic struck. And when that happened, I said, well, I guess we can't meet in person, so we'll have to do something virtual. And I thought about it and said, well, I'm doing it anyway. So I said, what's the difference if we have 4 people or if we have 100 people? Mm-hmm. I said, I'm doing it on Zoom. It's the same work anyway. So why not open it up to more people and to give people the chance to participate and to learn if they want to. So it just kind of manifested from there. And actually, joining the GOB network was probably a big increase in attendance. There was probably 15 or so people that would come every week before that. And now there's somewhere between, usually 30 or 35 most weeks. So, there's definitely been an uptick in attendance. And I think it's just doing it consistently and people find that there's not really too many of the places where they see somebody doing that. Mm-hmm. Apparently it's a niche that even with a lot of the paid training programs, you don't get something like that. So I said people have come to like it because they don't see it in too many other spots.
Well, another thing is the way I look at it is I've taken training and paid for training. You're doing it, right? You're out there closing 2 deals. And I'm not saying that the gurus out there are not doing it, but I mean, you're doing it on a daily basis. So I can see when you're presenting and going through and asking questions and showing things, more so as you're talking about, because you just did it probably on the deal you just closed last week. And for somebody that's trying to, learn that like that I think is a great characteristic to be able to answer those questions and be able to, put it into their language.
You know what? I'm glad to hear that. I think one of the other things that probably seems more relatable to people is that, being that I don't have, 5,000 units or 10,000 units yet, some of those guys, maybe they see as out of reach, but a lot of them probably see me more in reach because I'm still earlier in that process and still building up myself.
That is true. I would definitely do that. And again, your knowledge, and we appreciate you sharing with that, because I know that's bumped up my confidence, just attending and listening in the background and asking a few questions, because you do when you're, and I tell people this, when you're just sitting there in front of a spreadsheet, you can make that spreadsheet say anything it wants, right? That deal you're gonna close, right? You can make that spreadsheet, but also when you bounce it off somebody that has some based in reality, you say, oh wow, maybe that really wasn't such a good deal, and I shouldn't have tweaked that number here or there,
right? So one thing I always tell people, and this is for anybody starting out, as Pat said earlier, you have to have some standards, and we're always going to tweak numbers. So underwriting is part science and part art. There's a mix. It's not to say that it's all one or the other. And it's going to vary based on your experience, your market, all different things. And you may see your style change a little bit over time. But there's certain things you don't want to compromise. If you're compromising something just to get in a deal, it's not to say that you can't make money with it, because the reality is there's been a lot of operators the last decade that have made a lot of money and have been terrible operators. But they've made money because the markets went up and up and up.
Yeah.
And the good news is there may still be some room left in that. But the challenge is none of us know exactly when the market's going to reset. So never compromise your standards, because eventually if you're doing that when the market resets, you can get hurt very bad, and you could also lose the money of the investors that invested with you.
Yeah. And that's probably the most important part. It's not just only your money. It's now you've got, maybe 20 or 30 or 50 people, depending on the size of the deal, going along with you. That may not be your friends and family. It may be people you don't know, and that affects the ripple effect there too. So
yep,
definitely. Interesting. Well, listen, Charles, thank you very much for your time. Anybody have any questions? If not, I will kind of respect everybody's time here, and I do appreciate you guys, and thank you, Charles, for your time and effort. And
thank you, Pat.
It's been great. You shared a lot of great information, and thank you for coming on. I'm going to show you right now how to download the chat for everybody. When you take your mouse and go over to the participants, click on the participants button, And that opens on the, let's say, the right side of your screen. There's going to be 3 buttons on the bottom. There's going to be invite, mute all, and those 3 little dots. Click on that. Oops, I'm sorry. No, actually, I do apologize. I'm doing it wrong. I'm doing it wrong. Oh my gosh. Oh.
Pat, you're a lot more tech savvy than I am. Don't feel so good.
Oh my goodness. My God, they must have changed it. I do apologize. They must have changed it.
It's still there. It's right next to file and the 3 dots, and it just says save chat. So when you open up the chat,
Yep.
there's a little box down there. It says file, but right to the right of that box, click on those 3 dots, and then it'll tell you have you saved chat. You're right on point, Pat. And by the way, great presentation. It's so fascinating and interesting to hear people in the trenches working on the deal and hearing the different philosophies and the different ways to kind of work around that. So thank you so much. And Pat, thanks for bringing such great value to the meetup.
Well, thank you very much. I appreciate that. And I hope you guys got something out of it. Thank you, Bruce. I'll be calling you Bruce, sir. And thank you very much, everybody. And we will talk to you on the next one. Our next one is July 14th. It's 2 weeks from now. And for the schedule, again, go to opportunitycreator.com there and click on the Zoom mastermind links. And you can see the other one. Charles will be up there this weekend. So if you didn't catch it all, I'll have the recordings up there this weekend. And thank you very much and have a great evening, folks. Thank you very much for joining.
Good night, guys.
Thanks, Pat.
Thanks,
Charles.
Thanks, Charles.
Thank you.